Good afternoon all. Thank you for tuning in to listen to what will be our interim results for December 31st, 2017. For those of you that don't know me, my name is Greg Pearson, co-founder of Grit. I'm filling in today for Bronwyn Corbett. She's unfortunately had an incident on her mountain bike and will not be presenting today. But she will be traveling to South Africa with the team on Monday, so look forward to some of those one-on-one interviews and discussions with you. Also introducing today Leon van der Mertel, the CFO of the group, that will be taking you through the numbers. Always easy when you've got a good set of numbers to put out to stand up and do the presentation, so I'm sure Leon is looking forward to that. I think one of the big things that we need to highlight for 2017 is the rebranding of the company. The new name Grit has stood us in good stead. It actually has come through the relationships, the partnerships, and the determination from the team, stakeholders, and all involved. Has afforded us the benefit of where we are today, and that has come through loud and clear in the numbers. Moving on to the executive team. The team is stayed as is, has really focused on bedding down the assets in the last 6 months following the capital raise that we did in 2017. And then on to that, we'll be going through the countries that we're focusing on and the pipeline that we are creating. The countries that we are still operating in are the 5 that we have been in for some time now. There have been some good positive movements in those countries, the likes of Morocco. The Morocco has opened up the peg on the currency. It now operates within a band of 2.5%. Within Morocco, in the northern region, in the Tangiers, it's had a big focus within the industrial sector, and a lot of the automotives are moving into that region. Moving into Mozambique, a very positive story which has been off the back of a very tough time. The last 2 years, the macroeconomics in Mozambique have been very, very tough. We've seen some positive movements on the oil and gas sector with the announcement of the Anadarko FDI. There's a lot of movement within the TET, within the coal industry, where we are focused with one of our tenants, Vale. Mozambique is going to be the 4th largest gas provider globally in the near future, which will stand us in good stead with the investments that we've made into Mozambique to date and the relationships and partnerships that we have within that country. Moving on to Mauritius. Mauritius, our home destination, we're HQ'd out of. Tourism sector continues to do well. We have 4 tourism assets which do well, and it's probably a market and a sector that we'd probably look to increase on. Again, we don't take hospitality risk here, but just brick and mortar, so it is on a lease basis. Moving on to Zambia. Zambia is where we have our retail assets. Zambia has been stable, and it has actually moved into stable by, I think it was Moody's. Which is very positive for the centres and for our investment there. Moving on to Kenya. Kenya, we've got some great pipeline. Again, a country which has gone through instability last year with the elections that were taking place. I think it's a great platform for us to move forward with our tenant that we have in country, and there's great future prospects which we'll be announcing soon in the Kenyan market. We have got approval to move into 3 new jurisdictions. You'll see with Botswana, Ghana, Rwanda, and Senegal. Sorry, 4. Within the different countries, there are sectors that we will be focusing on. Ghana is a country that we have spent a lot of time on, but we haven't pushed the button yet on an investment due to, again, currency issues that the country was facing. Now that it is all stable, what we're seeing is repricing within those with those band of assets as well. We are focusing more on commercial within the central Accra region, and we are going to be announcing something soon in Ghana as well. Moving on to the last one, which is Senegal. Senegal again is a country with great growth forecast for it. Again, due to the size of the economy, it's a jurisdiction that we can invest large into. We have been tracking Senegal for some period of time, and we've actually looking at the hospitality sector there again. And the last one that we haven't mentioned yet is Seychelles. There's a hospitality, the hospitality sector in Seychelles is doing well, and again something that we'll probably be bringing to market soon. So on that note, I'm going to hand you over to Leon van der Mertel to take you through the rest of the business. Thank you.
Thanks, Greg. Well, the 6 months has definitely been quite a busy 6 months for us. Not only have we bed down all the assets that we acquired just after the financial year end, following the successful rights issue, but we've now got a solid set of results that is now showing the dividends of all the effort that the team has put in to get these assets transferred and making sure that there hasn't been any cash drag with the funds that we raised in June. Just to give you some of the key highlights, forecast distribution was met for the 6 months at 6.07 cents for the period. Whale continues to be something that differentiates us quite considerably from our peers. 7.4 years. This compares very favorably to the rest of the market, especially on the JSE. Weighted average cost of debt stayed pretty much stable, coming down 9 bips from 5.78 to 5.69. This is on the back of us settling some more expensive debt and also taking a bit more weighting in terms of euro debt versus the US dollar debt, in line with the assets that we acquired in the hospitality sector. Our NAV per share, it's increased to 152.7 net of dividends, which is a 2.08% increase. Dividend yield still very strong and attractive at 8.6 and 9.6 on the JSE. The portfolio itself has shown a lot of resilience, especially the Mozambique market, where we haven't seen too much movement. We've got still 96.1% occupancy. I think that compares well to industry norms, which are around about 4.8%. Property LTVs come down to about 44.8%, and we're seeing this tracking down a little bit further towards the end of the financial year, closer to the 40% mark. Just looking at Grit at a glance, I think it's just to reiterate a few points. Grit, we dual listed on the SEM as well as the JSE with dual primary listings. We've got an exceptional market cap for the size of the fund that we are at the moment, and growing $300 million. Again, to emphasize the strong dividend yield and the free float that we've got on the JSE. We'll be talking about liquidity of the shares as well a little bit later, which have remarkably increased, especially on the SEM. Nice to get to a point where we've now done our 8th declaration of dividends. Most of them have been spot on or slightly higher than the distribution that we had put to market, which is great, especially considering the macroeconomic headwinds we did have in Mozambique, just proving the resilience of our portfolio. The geographical diversification, we're now in 5 countries, a very small investment now into Botswana already, with Ghana and Botswana being the key targets for the next 6 months for growth, and we'll be driving that quite heavily. We now have 20 properties. Quite exciting to see the increase in the property values. We're now at $592 million of assets, up from 508. It's a 16% increase. This is on the back of the assets that transferred just after year end, as well as the completion of our Commodity House Phase 2 in Maputo. One of the key things for us is always to look at our shareholder base to make sure that our capital structure is going to be sufficient so that it can drive the growth that we want to get on the continent. We've got quite a big influx of new shareholders of late out of the UK market, the Frontier funds, as well as some of the African property funds that have now, and pension funds that have actually invested in the stock. I think one of the key things when we talk about Africa, people see risk. For us, we have to manage that risk very carefully, and this we do by quite a number of margins of safety that we built into our investment strategy. Key for us, counterparty. I think Bronwyn gets a brownie point for every time she says counterparty at presentations. I don't think we can say it enough. In Africa, you have to have players on the continent that know how to operate in Africa, and these are our focus when we look for tenants and buildings. Ability to raise debt, you'll see not only in the weighted average cost of debt coming down, but also the new facilities that we've been able to raise. In the last 6 months, we've been able to raise 2 additional facilities for Mozambique acquisitions. That was about 24 million. For us, one of the key things in looking at investment horizons is security of land tenure. We cannot have a situation where anyone claims title over that. So that is one of the key things before we even move into a new jurisdiction. In terms of the leases, we look predominantly for hard currency leases. US dollar and euro. At the moment, we're about 70-30 weighted between the US dollar and euro leases, giving our investors a very solid hard currency base for their returns. One of the key things, repatriation of funds. We need to be able to not only raise the rentals in country and be paid in hard currency, but we also need to repatriate those funds back to Mauritius. What we do have is political risk insurance, where we cover some of the jurisdictions. For example, in Mozambique, we have the political risk insurance that covers our currency inconvertibility and non-transferability risk. Even though we haven't had a claim on this, it's good to know that that margin of safety exists. Grit. This is one of the key things from our brand is who are we, what do we stand for, and what are our strategies into the future. I think one of the key things for us, growth. We want to be the biggest Pan-African fund on the continent and be a property powerhouse, where our tenants can rely on us as much as we can rely on them. This is going to be derived from expansion and diversification of the portfolio, not only in geographical sectors, but also targeting the key sectors in each of the economies that has got the biggest growth potentials. The strength of the team and the portfolio is quite clear. I think the consistency that we're getting in the results has now started to show through. We're now in 3.5 years worth of operations and consistently delivering on our targets. One of the key things for us as well is our team. Working in a very dynamic and complex environment, which is Africa, over a number of different countries, we need a very strong management team, as well as key staff that can drive this themselves, not always relying on the senior management team. I think that's been our biggest investment over the last year, and it's definitely bearing fruits with the strength of the people coming through the ranks. Just looking at our shareholder base, one of the key things, the PIC continues to be a real strong anchor shareholder for us, around the 30% mark. Management and staff, we still currently own 7%. This is quite a key thing for us to ensure that we have absolute ownership of this Grit, which is one of our babies in our lives. We not only have wives and kids, we also have a very big child in the name of Grit. We've had a number of funds coming to the stock lately. African pension funds are now also investing in our stock, which is very nice to see, as well as the UK frontier funds and some of the US frontier funds as well. One of the things that we've been working on, especially in the last 12 months, has been the liquidity of the share. This is something that we need to do to ensure that we can unlock the true value for our shareholders. The more stock that trades, the better it is going to be for all of our investors. We've seen a remarkable improvement in this following the extensive roadshows we did for the rights issue. We've now got a very broader base, much broader base of shareholders. Private investors are coming into the stock, and we've seen the liquidity, especially on the SEM, increase significantly. This is also to do with the fact that during October last year, we actually got inclusion into the SEM 10, and this has driven quite a few shareholders coming into the stock as well. If we look at our trading frequency, I think on this graph here, you can see, especially for the SEM, pretty much nothing in the first half of financial year 2017, and now tracking quite closely to our trading stats on the JSE. The volume traded, average day traded, all up very significantly, as you can see from the presentation there. Just differentiating ourselves from global REITs, we've done a bit of benchmarking ourselves to see where we compare with the rest of the REITs. If you just look at that last graph here, Middle East and Africa, you can see the superior returns that Grit is providing. This is benchmarked against quite a number of the peers in the global REIT structure. Although we are not a REIT, we do operate as a REIT. We do the full distributions every 6 months, just as a normal REIT would. Just looking at our property portfolio, you'll see the diversity now we have in the property portfolio of a number of sectors: retail, commercial, light industrial, hospitality, corporate accommodation, which is the Vale compound, all backed by very strong counterparty tenants that provide us the solid base for us to consistently grow our returns. Just looking at the total number of properties we have now, we have 20 properties that have now completely transferred. Property values, they're just close on the $600 million mark. Our weighted average cap rate, 7.8%, which is pretty stable to last year. Our WALE, 7.4. As I mentioned before, this is quite a key differentiator between our property portfolio and most others. Weighted average lease escalations sitting at 3%. Just bear in mind that this is dollar escalations and euro escalation based. And our rental per square meter sitting at about the $21 square meter, which does indicate that we're not in an over-rented situation. One of the key items that we did get quite a bit of success in the last 6 months was bringing our operating costs down. Not only did we find some savings in the actual operating costs, which has brought our ops cost percentage down from the 25% mark to 15%, it's also on the back of some of our assets that transferred, which are triple net lease-based assets where there are no operating costs. Vacancies still remain at 3.9%, which is quite competitive in terms of our peers. If we exclude the vacancies as a result of the ANFA redevelopment, we're actually only at 1.3%. Just looking again at our geographical footprint and our sectoral footprint, you can see that there's been a remarkable decrease in our geographical exposure to Mozambique and specifically, now 32.8%. We do have a soft target of no more than 25% exposure to any one economy. Following the next round of pipeline, we'll see Mozambique coming to 25%, which is very exciting for us, with the inclusion of new jurisdictions being Botswana and Ghana in the immediate future. The beneficiary of the reductions in both Morocco and Mozambique has been the investments in Mauritius. You'll see that now is about 24% of our portfolio, which is spot on where we want it in terms of our exposure to Mauritius. Sectorally, the split, you'll see that the retail sector is coming down quite considerably. I think our focus in the future is going to be more on the commercial side, especially with our entrance into the Ghanaian market. The retail sector does pose us a few more risks than we do in the commercial side, because the underlying currency in some circumstances is actually the local currency. So we do see that part of our sectoral split coming down quite considerably. Just looking at our counterparties, we wanted to give you a flavour of who the main tenants are. If we're looking at our exposure right now, biggest exposure at the moment is to Beachcomber, who is doing exceptionally well on the island with the 3 hotels that have come on board. Vale, which is our housing compound that we have in Tet, is one of our big tenants now. Lux Hotels, another very good tenant on the Mauritian hospitality space. Their results are superb. If you're looking at their occupancy rates around about the 90%, it does create a solid foundation for us to achieve these hospitality targets and growth that we do have. The likes of Vodacom, ShopRite, Anadarko, Game, Edcon, Imperial, as well as the Alshaya Group, which is a big retail tenant for us in Morocco. These are providing us the solid base of counterparties that we can rely on to ensure that our lease streams are consistently paid on time. Now going to the numbers. So just to highlight there, our NAV per share, if we're not looking at it without the dividends, it's at 158 versus the year-end close of 150. That's about a 5% increase. Net of dividends, 2% increase. Loan to value, 49.2% if we're looking at the portfolio and the RCF facilities we have in total. But to highlight again, 16.7 movement in our total income producing assets, which is our property investments, and share capital and total equity now at $330 million. Property investment value, as I've said, up to the 592. This has been achieved by the assets that were transferred during the last 6 months, being the Imperial Distribution Centre, the 3 assets from Beachcomber being the La Victoria, Mauritius and the Cananea hotels here in Mauritius, as well as the completion of Commodity House Phase 2, which was completed on time and on budget in Mozambique in November. Just trying to unpack the NAV evolution. If we see our NAV at year-end, we reported 150.94. That NAV was actually pregnant with distribution for about 1.38 cents, giving us a starting point for the year of 149. We've managed to grow that to 152.67 on the back of our portfolio, where it's generic growth coming through on the increases we do have on the lease escalations. Debt is something that we always have a strong focus on. For us, it's important to ensure that our debt exposure in terms of currency is carefully managed to the lease streams. You'll see there that about 30% of our portfolio is now euro-based, That has had a knock-on impact in bringing our weighted average cost of debt down. We still have a small exposure to Mets of 0.9%, which is immaterial in the grand scheme of things. Just one thing that we do manage on a complete basis is our net euro exposure position. You'll see it's come down quite considerably. We're now at 29% exposure in terms of net asset value in euros. Where we have found lots of success in the past is our weighted average cost of debt, which has come down considerably from the close on 7% when we started the fund. On the backdrop of the LIBOR increasing quite considerably over the period, we've managed to maintain the actual cost of funding. This is as a result of some fixed interest rate contracts that we have in place at the moment, but also the move to the euro-based debt. Our debt expiry profile, we've got a small facility that comes due now in February, which we're going to settle in cash. 2 revolver facilities in April and September, which are going to roll over. And then our debt in Mozambique, which is $38 million. That's going for final approval in the next coming weeks, and then we'll have that refinanced for an additional period of 3 years. We do continue to have a multi-banked approach. We always have to make sure that we are partnering with banks that have the same risk appetites for the jurisdictions that we operate in. This has resulted us in taking on quite a big partner in terms of Bank of China, who are now our biggest funders at 31% of our debt. Next in line is Standard Bank, which has gone up a little bit to 23%. We recently closed 2 finance transactions in Mozambique with them for $24 million. Investec Bank has come down generically through the portfolio, but it's nice to see the burgeoning relationships that we do now have with State Bank of Mauritius, which is focused more on the hospitality assets, but also Barclays Bank, who will be our funding partners going forward in a number of the new jurisdictions that we're going to be operating in. Distributable income, you'll see we've gone from $6.8 million of distributable income in the first 6 months of 2017 to $12.7 million. And it also compares extremely favorably versus the distributable income we had for the second half of 2017 of 8.2. The biggest contributors to this, you'll see, is the rental income that's increased. It's on the back of the transfer of the assets we own wholly, as well as the profits from the associates, where we own a portion of those assets, being the Beachcomber transaction as well as the 3 malls in Zambia. The other item just to highlight there is your interest income. The way we've structured some of our investments, it's got a large component of interest income that comes through there as well, and that gets paid on a monthly basis to us through the normal structures. If you see where our dividend stream has come from, started at 11.29 cents in our first year of operation, up to 11.75, 12.07 last year, and we continue to be on track for our market guidance of 3 to 5% increase on that figure for this financial year. Just to look at a few key items for the business, one of the more topical areas for us is transformation. Being operating in a lot of African countries, we do have to be cognizant of the fact that we are hosted in these countries, and we do want to be a responsible corporate citizen wherever we operate. We need to do this via empowering the local community and taking care of the environmental impacts that our buildings do have in these areas. And this is going to be a key focus for us going into the future as well. The implementation of our transformation policy, it's going to not only secure investors, especially out of the South African investor base, but also the local pension funds that in the areas that we do operate in. And then when we're looking internationally at the DFIs, trying to arrange better finance transactions for some of the deals, it's going to stand us in very good stead. This is going to definitely help us improve our investor base, enhance our liquidity, and ultimately create value for our shareholders. When it comes to our new transformation partners that came into being in the last 6 months, we're very excited to have them on board. One of their representatives is actually sitting on our board at the moment with strategic advice. And it also brings a whole diverse base of skills. One of the key items is the internalization of our property management. With us having such a key focus on our counterparty, we wanted to make sure that we actually own the relationship that we have with our tenant and not work through external property managers. One of our transformation partners is going to play a key role in that whole transformation sector. We've spoken about Ghana before. I think one of the key highlights for us is to to emphasize that Ghana as an investment destination, not only has the government become extremely pro-business, but they're also going to be implementing REITs. This has been targeted in their budget speech for implementation during this financial year. We're very excited by the fact that not only will we have a very robust long-term tax planning for our investments into Ghana, but it does create a very buoyant local property market wherever REITs are successfully implemented. Botswana being another investment-grade country in Africa, we've been looking at it for a while. We have now identified the portfolio of assets that we are after, and final negotiations are underway. And we're hoping to come to market with a very important announcement on this in the time to come. But for us, it's one of those countries that does create a very solid base for growth. The property market there is quite good. We're not too keen on the retail sector there, but a larger focus on the industrial side as well as some of the commercial buildings. The Anthroplace Shopping Centre, we're very excited with the progress we've made there over the last couple of months. We have the project plan now in full swing. It's going to be creating 2,700 square meters of GLA. We've now completed all the tenant moves. We've done quite a bit of work with identifying new tenants to get the tenant mix in the centre exactly spot on. We've got quite a number of offers that are on the table from prospective tenants, and we're now trying to match those to the actual needs of the centre. We're already at our pre-let requirements to go ahead with the project. Local council permission is just about granted, and we're hoping to get stuck into the main part of the rebuild during the month of March. Over to you, Greg.
Thank you. Just to close out the presentation, what we're going to be doing now is just explaining what Grit is looking ahead on, and the pipeline and prospects that are going to lead into 2018. That being said, 2017 and 2016 on a global trend was very difficult. So for the company to grow as it did and still put out the exceptional results that it has taken a lot of determination and a lot of resilience. Moving into 2018, we've seen a lot more buoyancy coming through on a global level as well as into Africa. If you look again across the East African range, you'll see that logistics have started to come through quite strong, and we're very well positioned there with the tenants and the developments that we have in the pipeline. If you look at Central and Southern Africa on the Mozambican coastline and into Southern and Central Africa, you'll see the oil and gas story starting to come through again. And then West Africa, even though the oil and gas has been difficult for Nigeria and then the currency there, you'll see Ghana and the likes of Senegal have put out great GDP growth, even though it's not based off the commodity growth. So if you look at the country diversification, that's been a strategy from Grit from day one. What we want to do is in a frontier or emerging market, you'll always see that the trends, you've got a 5-year cycle of increase, and then you'll always have a downward turn as the country looks to stabilize. With us now being across more than the 5 African countries, what that does is it limits the risk on the downturn. So that's been a focus of Grit from day one and is coming through now really strong. The introduction of new shareholders. Grit has been around from the US to Europe to Africa itself, looking for a new investor base. What we've seen in 2017 and into 2018, a lot of the pension funds of Africa are starting to come through and looking for those growths and returns, which are exceeding the growths and returns that they're seeing in Europe at the moment in hard currency. What we've also done is attracted some European investments, which has been fantastic. Those are typically going to be the larger investors coming forward. And now that Grit has got to that critical mass where it can invite those bigger investors to come in with sizable checks, I think we're going to have a good growth strategy moving forward. Expansion into international brands. Through this difficult last 2-3 years on a global trend, what we've done is we've really focused on those key stakeholders and provided the solutions that they require in Africa for their real estate. As Leon has taken you through today with regards to the Vale compound, the Imperial Logistics Centres, we're very well positioned now to move in this increase and this burgeoning market coming through Africa, and I think the whole sentiment of Africa is actually on the up at the moment. I think the last thing that we need to highlight is the total return that we're looking for in 2018. We're putting out that we're going to have about a 12% total return on the investment, which we feel is a really fantastic return for Africa. Again, with the counterparty as the underpin and the growth that we're forecasting, we're really looking forward to a positive 2018. On that note, thank you very much for listening and hearing our last half an hour, and looking forward to seeing you in the near future. Thank you very much.
Thank you.